After another 4% drop today on Wednesday, February 26th, Tesla's stock price is now under $300 and the market cap is below $1 trillion again. The share price is now less than 2/3 of its record price of $480 on December 17th. That's a 40% drop. Although other tech stocks are getting hit with the market recalibration this week, analysts have put a hold on Tesla due to issues in the near term. Elon Musk's once biggest supporters and early investor Ross Garber warns that Tesla's stock could drop as much as 50% in 2025 because of 4 major concerns. First, Tesla's full self-driving might pose challenges this year. Tesla's FSD technology, which relies on cameras rather than LiDAR sensors like Waymo, may never meet safety standards needed for a fully autonomous taxi network. Tesla's FSD system is currently at a level 2 system for safety standards. This means it requires constant driver supervision. And in order to be fully autonomous, the safety standards have to be at level 4 or 5, which allows the vehicle to operate without human intervention. The FSD system needs to incorporate redundant sensors and fail-safe mechanisms so that if there is a malfunction, the vehicle is capable of safely transitioning to a manual mode or come to a controlled stop. Analysts and regulators have pointed out that Tesla needs to make significant hardware improvements, such as incorporating LiDAR sensors like Waymo, and there are also cybersecurity measures that need to be upgraded to protect the system from potential hacking or other malicious interference. Second, Elon Musk's divided attention has been a concern for investors. SpaceX, XAI, Doge, and his political involvement have been detracting him from his focus on Tesla's technological advancement. There is also concern about brand damage on Tesla due to Musk's unpopular Doge-related government initiatives. Not only has the stock dropped more than 17% since Trump's inauguration, Musk's lack of focus on Tesla has affected the company's sales, with the first annual sales decline in 12 years, even as global EV sales rose 7.3% in 2024. Slowing vehicle sales is another concern, with Tesla experiencing its first annual decline in EV sales and increased competition from companies like China's BYD. Their core business appears to be affected. In fact, BYD has brought better returns than Tesla in the last 3 years. Analysts forecast that the first quarter deliveries will miss Wall Street's expectations. Future Fund Active ETF co-founder Gary Black has estimated that Tesla could deliver around 380,000 vehicles, well below the 422,000 units predicted by many Wall Street analysts. On X on February 25th, he wrote that he believes Tesla's stock will fall further because sales volume for 2025 will be flat compared to 2024. The decline in sales volume is also likely to be impacted by Tesla's recall of 375,000 vehicles in the US last week, which was due to failing power-assisted steering systems. And further to that, Europe's January sales data have shown that Tesla's facing challenges with declining demand there. For example, France dipped 63% year over year, and Germany declined 60% year over year in Tesla sales. The last concern is the overvaluation. Although Tesla's high PE ratio is because many investors see Tesla as an FSD software growth stock rather than a pure electric vehicle company, analysts are still concerned that the stock is overvalued. For example, its forward PE ratio is 106 as of today's open, which is more than 3 times the next most expensive stock, Nvidia. JP Morgan's analyst reiterated its belief that the target price is $135, which is a 60% downside from its current levels. However, not all experts have a gloomy outlook. A recent analysis highlights that Tesla is preparing to roll out updated FSD features in China, even if it faces stiff competition from BYD and technology partnerships between other major players like SAIC and Huawei. There was uncertainty and speculation last week that China could delay FSD approval due to the tariff war, and that Tesla would need to do extensive testing on China roads before opening up the features to drivers. But new reports on Monday suggest that Beijing has or is about to grant a license to Tesla for their FSD because Tesla will be opening up the FSD features in the next few days. Further fueling long-term optimism is Tesla's plan to launch a self-driving robotaxi service in Austin, Texas, as early as June. This move is going to pit Tesla against competitors like Uber and Waymo in a market that many believe could be worth trillions of dollars. Tesla plans to use a mix of vehicles, some owned by regular drivers and others from its own fleet, all equipped with FSD. Although Tesla's FSD is still considered a level 2 system in safety standards and faces technical challenges, this push into autonomous ride-hailing is seen as a major future catalyst. Analyst Dan Ives of Wedbush offered a balanced view on these developments. While he acknowledges that concerns over Musk's various distractions and potential brand damage exist, he also believes these are containable issues that will not change the long-term outlook for Tesla. Ives expects that new Model Y deliveries, the launch of a lower-priced Tesla model slated to come out mid-year, and progress in Tesla's autonomous driving and robotics initiatives will drive growth at an annual rate of 20 to 25% between 2025 and 2030. For investors, the picture is becoming a bit clearer with analysts' views. In the short term, Tesla's stock sees potential for a further decline and may continue to show struggle. But the bet on the long term still remains consistent for analysts, which is Tesla's successful transition to full-service AI-driven mobility company.